All right, welcome back, everybody. Let's focus now on the impact of the coronavirus on the energy markets. Just this morning, Reuters reporting that OPEC and its allies are considering a further cut in oil output of 500,000 barrels a day because of the impact of the outbreak on oil demand. They're considering holding a ministerial meeting on February 14th ahead of the next scheduled meeting in March. Let's take a look at the energy sector in the midst of this market sell-off. And joining us for that right now is Rob Thummel. He is Tortoise Portfolio Manager. And Rob, obviously, we've seen a pullback because of the coronavirus and the demand picture, what that's going to mean for the second largest economy in the world. Do you think that pullback is warranted?
Well, oil prices have declined probably 17% year to date, Becky. And so typically when oil prices fall, so does the energy sector. But we do see the energy sector here at Tortoise in evolution, and it's moving beyond oil. And there are opportunities to make money in the energy sector that doesn't involve investing in oil prices.
Like what?
Well, so longer term, as the energy sector evolves, we see a combination of natural gas and renewables combining to reduce carbon dioxide emissions. Everybody hates the energy sector because of carbon emissions. Well, in the U.S., it's been proven that if you combine fossil fuels, and specifically natural gas, with renewables, you can reduce carbon emissions in the U.S. You take that same formula and you apply it in places like China and India where they use a lot more coal, that's a recipe for success. So companies that are doing that are companies like Cheniere Energy, who is the largest and the purest way to play LNG or liquefied natural gas exports to places like China. So Cheniere is going to significantly grow their cash flow over the next several years as demand out of China for natural gas rises significantly.
Rob, can you talk about oil at all? And what do you think when OPEC says they might do an emergency cut as soon as this week, if that's going to help stabilize the price at all?
Yeah, Michelle, that's important. The biggest thing in the oil price or in the oil market is global oil inventories. What we've seen in the past, if global oil inventories rise, oil prices fall. OPEC knows this. They're watching this very closely. And because, obviously, of the demand that is less in China now because of the coronavirus, you will likely see oil inventories rise. And so OPEC needs to react to that, and they're looking at it very closely depending on the duration of this coronavirus. So if they do take some action, obviously that will stabilize oil prices from here.
Rob, we had a conversation on Friday with Jim Cramer, who says that he thinks nobody should go near any of these energy stocks because it's just not going to be a place that people invest. He called it basically the new cigarette stocks, that you have portfolio managers, but especially pension funds and others who will not be willing to invest because millennials don't want to see any additional money. They don't want to invest their own money in fossil fuels. What do you say to that?
Yeah, well, Jim's a legend and has great opinions all the time. What we would say at Tortoise to that is once again, fossil fuels are hated because of the connection with rising carbon emissions. And it's not an either-or proposition, basically. It's not either invest in fossil fuels or invest in renewables. It's actually a both-and proposition. It's invest in fossil fuels, natural gas, and invest in renewables. And you put that combination together, it's very powerful. It can actually reduce carbon emissions. If you displace coal with natural gas and renewables, right, you can actually reduce carbon emissions.
The question, though, is whether the sort of Larry Fink view of the world is going to mean that all of this is just dead money. And by the way, it's been relatively dead money for the last decade if you were to compare it to the S&P 500 or something else. And whether there's something else going on in terms of the psychology, as Becky and Cramer were talking about on Friday, that there's something, that there really is something in the water, if you will, in terms of how investors are thinking about this.
Yeah. Well, Andrew, the way to think about it, we're thinking about it going forward is from an energy sector perspective, the energy sector actually and the utility sector and renewables are going to become synonymous. They're all going to become one sector. And so rather than focus on the oil and gas producers where there's a lot of commodity price exposure, where there's a lot of volatility, focus on the demand, the users of the energy, because energy is essential. We're all going to need it.
We're all going to need it. I'm not disagreeing. I'm just wondering whether investors are going to give credit to that because there are certain investors that clearly don't want to.
Yeah, well, that's true, but if the energy sector can deliver the cash flow, right? So we're not tobacco stocks. Energy demand is not going down. 25% people probably smoke tobacco. I don't know what the statistic is. 100% of people use energy. So everybody's going to need energy, and more energy is being consumed every day. Less and less tobacco is probably being consumed every day. More and more energy is being consumed. You're going to need it. So energy infrastructure companies, high dividend yields, I think are really important, especially in this environment when, you know, the Treasury is at 1.5%, 10-year Treasury. You need dividend yields, and you can get them in certain energy infrastructure stocks like Enterprise Products Partners, like Magellan Midstream Partners. These are well-covered dividends. They're growing dividends. They're companies that operate essential critical assets.